What is going on, you guys? And welcome back to the channel. Happy New Year. Happy New Year, everyone tuning in. And Happy New Year, Adrian. Thank you for joining us.
Happy New Year, my friend. Good to see you.
Good to see you as always. It's been a while. Has it been a year since the last time you've been on? Maybe roughly.
It's possible. I mean, time flies when you're doing what you love, right?
There you go.
It could be, maybe it's a year, maybe it's not. I don't know, but it's good to do this catch up. We should do it every year for sure. Always open to talking to your audience as well. I know most of them are Canadian and a lot of them are curious about income and the high yield stuff, which as you know, my channel focuses on. So.
It's your expertise, man. That's how it is. Well, the reason, Adrian, to bring you on was for your context. I did this little series where I was like, top ETFs to buy in 2025. Then I went top dividend ETFs to buy in 2025. And then in the comments, I was teasing, do you guys want one about high income ETFs? And I actually started doing my script. I was playing out the videos. I'm like, why don't we just bring you on, the man that specializes in this? Because I think you could provide my audience with so much, honestly, more value than I could in this realm. This is your bread and butter. This is your expertise. For those that don't know, Adrian has a tremendous channel that focuses in on high income strategies, covered calls, all that entire realm. That's the context for today's video. So I'd love for you to be able to give our audience some suggestions, some literal ideas to look into, to research, to do their own due diligence. Yeah. And I think just like overall, like where your head's at in the space, or anything they need to be aware about. We can have just a good long discussion. I'm happy to kick it off.
I'm ready, man. I am ready.
Let's do it. Well, where do you want to start, man? I appreciate you being here.
Yeah, same. It's good to be here. And maybe we could start with just a general overview of what's been happening in this space. So, there's the high yield space, but I really focus more on the covered call space, which is by definition, higher yielding. So, and I'll probably focus a little bit more on Canada. I think most of your audience are Canadians, I think, at this point.
They definitely are, but they always express interest for both. So whatever you think is top of your radar, don't hesitate to share it, because they are Canadian, but they like both, looking at both options.
So in the income world or the covered call space, it's actually a funny story. Canada was ahead of the US. The US is slowly catching up, but that US is obviously their stock market is king. They're catching up, let's just say, very, very, very quickly. So I would say 2024, and just on the Canadian side in general, I feel like, as a covered call income investor, primarily, we have pretty much everything we need now. So, just like on the growth side, you have index funds, you have dividend funds, you have, what I mean? You pretty much have everything. You got all the indexes. BMO has a lot of them. Global X Canada has a lot of them. You got all your indexes. We kind of have the same thing finally now if you're a covered call investor, because remember, you could do covered calls on anything, on a single stock, on an index, on a group of stocks, on a group of utility stocks, healthcare stocks. So we didn't have this before in the past when I started, even 4 or 5 years ago.
Right.
Now we have everything. You could buy the S&P 500 with covered calls, the NASDAQ 100 with covered calls, the Russell 2000 just came out by Global X with covered calls. You like dividend stocks? Let's do dividend stocks with covered calls. Now we even have single stock covered call ETFs,
of that,
which we'll talk about. I'm sure maybe your audience has questions about that. So Purpose is in that game, but even Harvest now is in that game. And there's some exciting news from Harvest that just came out. Gonna have some big launches probably in the next month or two, this month or next month. We'll talk about that. But I would say, generally speaking, I'm a very happy camper, because anything you have everything we need now as a covered call income investor. And a lot of people think, oh, well, it's completely different. You got to think beyond the ticker symbol, I think. So some people, they don't look beyond the ticker symbol. So if you're investing in an S&P 500 with covered calls, you're really investing in the S&P 500. If you actually look at the charts versus the S&P 500, it's almost identical, almost in parallel, you could say. So in Canada, we're very spoiled. We have, I would say, almost everything we need. The only thing that's missing, and I put it on my Christmas list, my wish list, I actually made a video, what I want for Christmas is daily covered calls. So you could do monthly covered calls, weekly covered calls. That's more like classic. I'm talking about the duration of the call. Hopefully your audience knows what a covered call is. That's pretty basic stuff.
If they don't, they can head over to your channel. I'm sure you've got
exactly. Or just AI. Now you Google it and AI will give you a response, or you know what I mean? And that, it's actually pretty good. But in the US now, the big thing that came out in 2024 is now they could do daily options, daily covered calls. So this is they're called zero DTE, zero, daily time to expiry. So it's a call option that expires in 1 day. So you have much less timing risk. So now you have these covered call ETFs in. You could only do them on the indexes for now, on the S&P 500.
Yeah.
Then the Nasdaq and the Russell. But on the US, you got daily covered call options ETF, which are pretty fun, and they're a couple of them are even outperforming the index with no leverage or anything, which is very interesting. So, on the Canadian side, we don't have that yet. That's what I think is hopefully coming. But pretty much we have everything we need in terms of, if you really want to be an income investor, covered call income investor that likes indexes, that wants to invest in indexes, that still, wants to make that transition, I guess, from growth oriented to income oriented. You could be invested in the same thing, the same indexes. You're just switching how you're getting your return. So,
well, let me say this, that obviously I agree with you. It's a great overall benefit for the space that we have this whole suite of options out there, and these new products coming like literally on a monthly basis, quarterly basis, tons and tons. But I do put myself in the shoes of, the audience or the viewer who may be saying, well, I want my exposure to this, but they're completely overwhelmed with where to look, because you take the more, even for someone who's got the basic level of knowledge or intermediate, and they want to invest in a normal index, or the Nasdaq or the S&P. There's so many of them that it's not, you can dial into what you want. Like you said, this past 5 minutes we've been chatting about all the suite of options. How do you go about approaching things? And for example, someone who's wanting to get exposed, like, do you clump them into different categories? Where should a beginner start to look? Maybe share some insight there.
Yeah, it's definitely easy to get overwhelmed. No matter what type of investor you are, growth, dividend, or income, which I feel are really the three styles of investing, not speculating, investing.
Right.
You could definitely get overwhelmed. I think the first thing you have to do is really look at the base. What is the assets that you're investing in?
Right.
That's always the foundation, the base. So if you're someone who really, really loves index investing, like investing in index funds like I do, you could just have always that as the foundation of your investing style. So if you want to go from growth to income, or you want to dabble in maybe some covered call income ETFs, I would say just start with probably the ones that are index based, that you really know and understand.
The
So
S&P 500, for instance.
S&P 500, Nasdaq 100, you got Russell. That's a bit lesser known, small caps. So there's even Canadian ones. That would be the TSX 60. So I would always start, if you want to dip your toes, and go with the safer stuff. Just like
like anything else, you dip your toes, right? You don't dive into the deep end with a ultra leveraged kind of crazy individual single stock thing if you don't know what you're doing. It's, hey, if you're an S&P 5 investor and you're looking to find a way to get, take this asset and spin you off some income, you're saying a great entry point for them into this passive income world is taking a very basic approach, the S&P with covered calls, for instance.
Yeah, it's like even growth investing or normal investing. I'm sure. What do you typically recommend for people who are starting to invest just as a growth investor? You're not going to recommend, you got to pick and choose your individual stocks.
True.
No, buy VFV or buy XEQT or ZEQT, right? I recently saw your portfolio. You got rid of all your stock. You went with the S&P in the whole world. So I would suggest the same concept really applies for income investors, because now we have, and it's in large part to guys like Hamilton, Global X especially. They really, and I'm talking about Global X Canada, because there's Global X and there's Global X Canada. It used to be called Horizon, right? Now it's Global X. They really focus on the indexes. So just like a beginner with, it can never go wrong with the S&P 500. On the income side, it's the same thing. You can't go wrong with an S&P 500 covered call style.
Now, I was actually going to save the questions to the very end of this session, but why don't I kind of scatter them through? I'm just trying to, again, put myself in the shoes of a beginner here. Why would someone take the S&P 500, Adrian, or the Nasdaq, and then, work in covered calls into that strategy? Like, what are the pros and the cons of that? Obviously income, and, the con would be you're giving up growth. Like, how do you go about viewing that?
Yeah, well, the pro would be the same pro if you would do it on the growth side, right? Diversification, lower cost, automatic rebalancing. what I typically like to say is that when you're buying an index fund, whether it's growth or income, it doesn't need babysitting, right? You're diversified. The index always changes. The S&P 500 was very different 40 years ago. You don't have to worry about that as an investor. It's a very good basic, probably one of the most perfect ways, in my opinion, to invest in equities, stocks overall, is index funds. Mm-hmm. So you would just apply that. If you're asking me why would you buy an index, a covered call S&P 500, let's say.
Correct. Yeah.
Well, the general premise behind covered calls, or why you do it, it's primarily for income. So a covered call or covered call strategy means you're basically giving up some upside, or you're selling upside for those premiums, right? And obviously you're not doing it. You could buy VFV and sell your own calls, but if you buy a one that's managed, they're doing it all for you, right? So essentially you're giving up some of the upside, and that is the key of where it's different from fund manager to fund manager. How much upside am I giving up? But essentially the premise is you're giving up some of it for that income. So when you add covered calls to something, you're actually automatically lowering your volatility. That's why when you go to any website like BMO, you'll always look at the description, lowers volatility, because so you're actually lowering your risk. You're not increasing it, because those premiums, it's really cushioning the downside if the market goes down, right? Because you're giving up upside. But if there is no upside, those premiums is what's cushioning your downside. Remember, risk, volatility, that all has to do with the downside, not the upside. So that's why covered call ETFs or any covered call strategy tends to outperform whatever it is during a time frame or the underlying. So we'll stick with the S&P 500. S&P 500 index fund or index ETF, like a VSP, VFV, VOO in the States, versus an S&P 500 ETF with covered calls. During a flatter down market, the covered call one will beat the one without the covered calls, because there is no upside. Right. So you're getting those premiums, it's cushioning. But during a rocket ship up, it tends, the growth one tends to do better, tends to outperform, because the covered call guy is selling some of the upside. But you'll be extremely surprised, like I was. One of the big things I was surprised by in 2024 is that now you have these covered call index ETFs that are not only on par in terms of performance. I'm not talking about yield here. I'm talking about total return performance. Mm-hmm. Some of them are even beating the index, which I never even knew.
Even in an up market, you're saying.
That's what's so incredible, even in an up market. So on the Canadian side, I believe I'm 99.9% sure it's because of the leverage. So in Canada, a lot of these covered call ETFs, they have a little bit of leverage, 25%, which is pretty, it's not that much.
It's marginal,
but some people say, or I know your audience is going to say 25% leverage. Doesn't that increase my risk? Well, yes, it does. But adding covered calls lowers the risk. So it kind of balances out a little bit. So if you have a S&P 500 covered call ETF with 25% leverage, the risk level or volatility level is more or less the same as just a regular S&P 500. Covered calls lowers the risk, 25% increases it. And then if you do the total return comparison, I got some stuff ready, you'll see that some of them are really on par and some of them are actually beating them as well.
Well, why don't we dive into that? I appreciate that. Yeah, that kind of preamble. Why don't we get into some of the selections that you've prepared? Because that's what people want to know. And like I said, I've got a big list of questions from our audience over on Instagram that I would love to highlight after the fact. But
for sure. I'm ready to go, and I have a few. I would say 3 sets ready, and they're really going to be focused more on the index or diversified ones, which I feel if you're going to start, you might as well go with the things that are diversified, lower risk, just to dip your toe in.
For sure. So, it's perfect selections for our audience, Adrian, because like you said, if someone wants to, I would assume a lot of these people are looking for the generic kind of getting started. And then as you get more experience, and if this is a world you choose to go down, there's a whole rabbit hole you can go through. But I love the idea of more generic index ones.
For sure. And I got some total return comparisons.
We'll talk about that later. Yes.
I'll share my screen. You let me know when you could see.
Okay. Yep. See if it works. present. Try hitting present.
Yeah, let me see. Select window. Okay, entire screen. Sorry, that was my bad. You should be able to see it now.
Perfect. Yep, I think I see that right there.
Okay.
Boom.
So I'll start with the Hamilton ones. We could go to Global X, and then I'll talk about Harvest, which are, I would say, three of top providers of covered call ETFs that are index based, I would say. So you have HDIV first. I call this OG. It came out quite a while ago. So HDIV really tries to focus on the Canadian market. You see here that it's it's trying to mimic or have diversification similar to the TSX 60, which is the overall Canadian market, but it's not 100% Canadian here. They added some US exposures as well. If you actually scroll down, you could see this is a fund of funds. So it's an ETF that holds exclusively all other Hamilton covered call ETFs, and some of them are not covered call, but most of them are. When you see the yield maximizer, it means it's a covered call strategy. But these two here, Hudson, HFIN, are not. But either way, it's primarily covered calls, and you're looking at a yield of about 11.5%. Now, even if you look at the sector, you could see that it's a fairly Canadian type, or financials, utilities, and energy and gold are pretty high up. But there's some healthcare, there's some technology as well. They added some US exposure. So if we just compare like total return here, and I pretty much selected what I feel is, you could see my screen, right?
And I can definitely see it. And I guess for the beginners in my audience, the reason why we look at total return here is we've covered this in our previous video, so I hate to like drag on it again, Adrian, or make you explain. We can see that too, by the way. One of the big arguments that you'll get against this style of investing is, well, hey, you see the 8, 9, 10, 11% yield. That draws people in, but you see the share price. If you were to pull up the share price, you see that degrade over time. So, the total capital you've invested, some people may see that number come down and they're pulling in yield. I think there's a bit of confusion there or misconceptions. This is why you bring up this total return metric, which includes the dividends, factoring that in. Is that right?
Yeah, we could talk about that first, because it's still by far the number one concern I get.
Let's revisit that. Just again, I'm sure a lot of my audience knows, but just in case.
Yeah. So when you're looking, what's important is total return, because total return includes price return. It's net of fees. So a lot of people, especially newer investors, they typically, what do they look at first? The stock chart, right? And if you're looking at a stock that gives no dividend, no problem. You can look at the stock chart, because all the total return is the price return. There's no dividend. But with these high yield funds, you have to understand that they're giving out quite a bit of monthly income. That income actually comes out of the net asset value every month, aka you could say the stock price.
Yeah.
Right. So that's why on every X dividend date, let's say the dividend's 10 cents or 20 cents, the day of the X dividend date, the stock drops by 10 cents or 20 cents, because they're literally taking out that 10 cents or 20 cents from the stock price and they're giving it to you in cash. So a lot of people look at the stock chart, it doesn't look that great, but even you on your channel, you showed, stock charts that don't look great, but if you look at the total return, it's really good. I think it was LBS from Brompton, a split fund.
I don't think I would have talked. Maybe my dad did, but not myself. But anyways.
Yeah. So, I mean, total return is the ultimate truth. That's what you have to look at. So you have to remember that money that you're getting every month, people think, oh, I'm just going to spend it willy-nilly. And that's actually part of your investment, right? So if you're not reinvesting all of it or a portion of it, you have to take that in consideration. But just looking at the stock price does not dictate the performance of how well the fund is doing. So another thing is very, very important to understand is that an income investment, like a covered call ETF, could be turned into a growth investment like this by turning on the drip. If you turn on the drip, that income ETF is automatically a growth ETF, right? Because you're getting your growth with more units, you're compounding. But in the end, you have to remember that it's really about the growth of your investment, not the stock price growth, right? It's the total return. So this is why I always look at total return. And when you do when you compare ETFs, you got to do total return comparison. So
appreciate that.
You know, that whole premise of NAV erosion, it's a myth in my opinion, because how that word erosion means it's disappearing, but it's not. You're getting it in cash and you could do whatever you want with it. So how is it erosion if you're actually getting it in cash, right? It doesn't make sense. So you got to look at total return to get the full picture. And a perfect example would be, you know, the examples I prepared. If you look at the stock chart of HDIV, you know, it's probably, it doesn't look impressive at all. All of these stock charts don't look impressive, but when you look at the total return, it's a different story, right? So let me go back and share my screen here, entire screen. So, you know, I chose HDIV because it's pretty Canadian focused. So, you know, since the audience is mostly Canadian, and I compared it to VDY, which, as you know, is, you know, the Vanguard dividend. It's probably the top performing dividend Canadian style ETF on the Canadian market. Of course, there's things like XIU, VCN, XIC, which is more overall Canada, but VDY is a bit higher yield because it focuses only on those dividend stocks.
Yeah.
And you could see that an investment in HDIV starting in the beginning of 2023. So this is basically 2 years of data here. You could see that HDIV is comfortably outperforming VDY with dividends invested. So the top half is with dividends invested. The bottom half of this is if you're basically spending all the dividends, but either way, you're outperforming VDY. So HDIV has a much higher MER, right? The MER is over 2%. Why? Because there's leverage costs. They're included in there. But remember, total return is always net of MER. It's always net of fees, right? So you could clearly see that if you would have put 10 grand in HDIV the beginning of 2023 and 10 grand in VDY, you would have been much better off with HDIV, right? That's an example. So another one, you know, that's really for if you want to dip your toes, I think, and you like Canadian stocks, you know,
well, I'm
the
glad
banks are in there and everything. So
I'm glad you mentioned that one, Adrian, because on my notes, this was one of the ones that was going to be included in my list if I didn't have you here. So I'm glad this is the one you're talking about as well.
Yeah, and this is from Hamilton, and another one from Hamilton is HYLD, which is, if I remember when when Blossom came out, and I poured it all my audience. I think HYLD was like the top stock for a time. I think now it's VFE or whatever. But
VFE now, correct. But I remember that.
The good old days, remember?
Yeah.
The early Blossom days. But anyway, HYLD is more closely associated with the S&P 500. So it's this one here. I don't know if you could see the Hamilton website.
Yep.
So it's similar to HDIV, very similar strategy, except it's all covered call. Like if you look at the ETFs inside of it, and I don't want to go on and on, but they're basically all covered call ETFs, which if you combine them, you're pretty much getting exposure to the S&P 500. Think of it like a concentrated version of the S&P 500. It's very, very, very similar. And if you look at the graph, the proof is in the pudding. I'm comparing HYLD to VSP. So as you know, VSP is the Vanguard S&P 500 hedged to CAD. The reason I'm doing it with VSP and not VFV is because HYLD is hedged to CAD. So you got to do apples to apples. Yeah. And another thing, HYLD went through some transformation over the years. And starting at the beginning of this year is really when we have the HYLD finalized. So here's another example where HYLD is outperforming the Vanguard S&P 500. This is with dividends reinvested and dividends not reinvested. So if you're just pulling everything out. So two things to notice. One, the performance is better. So you have an income ETF here that's outperforming a growth ETF, right? If you would have put 10 grand, your 10 grand would be this versus this. It's not by, a crazy amount. Yeah. And another thing I want to point out is if you actually look at the chart, you see how close it is, right? You see how identical it is. And that's because an investment in HYLD, you could say is an investment pretty much in the S&P 500. So there's not a crazy difference with a covered call S&P 500 versus a regular S&P 500. It's very important for people to understand because they think it's something just completely crazy covered calls that's completely different. Not really. You're just
it's a layer. It's a layer on top of. It's a layer on top.
I mean, the proof is in the pudding.
Yeah, and of course, this is certain time frames. Like, there will be other time frames where this type of performance isn't the case. But one thing, Adrian, I've said on the channel previously, me and Mark, we've always thought that these two funds were very complementary, right? Is that still the case? Is that what
H-
you get the Canadian side and the US side?
HDIV and HYLD you're talking about? Yes, it is. There's overlap between the two. You'll actually see some of the same ETFs in both, like the QMAX, like the technology ones. But yes, they're very complementary if you want US and Canada, North America. They're very complementary. Yeah.
Very
They
nice. No, love
are.
those suggestions.
So those are two, like, you know, I'm just trying to tell your audience, like, ones that are good to start with because they're diversified. They're very close. They're based on indexes. So these two they're not actually the indexes, but as you can see in the charts, they follow very close, a lot of the same stocks. So it's easier to get started with something that's a bit safer. So they both have about 11 to 12.5% yield. And as you could see, even if you look at the stock chart, you'll never, if you compare the VSP and HYLD stock chart side by side, you'll never think in a million years HYLD is beating VSP. But you got to do the total returns, right? So HYLD on drip basically has beaten VSP on drip, you could say. So this is something I didn't think was going to be possible. It's a pleasant surprise for me, obviously. So this is pretty good. So if you want, I could actually go to the Global X ones, which are actual indexes. So these are, I literally just want the index, you could do that as well. So I'll talk about two of them here. I'll share my screen again. Share. Takes long to share on this thing.
I know.
It's all good. So
we got nothing but time today.
All right. Well, I'll talk about two of them. I'll talk about, my personal favorite indexes, the S&P 500 and NASDAQ 100. Okay, the American top indexes. Obviously, your audience knows what these indexes are all about. So you have USCL, which is literally the Global X Enhanced S&P 500 covered call ETF. It's literally an investment in the S&P 500 with covered calls, and you could see the yields about 11.5. And the enhanced here, it's using 25% leverage as well, just like HDIV and HYLD. They have the same thing on the NASDAQ, which is called QQCL. Same thing. And obviously, this is a mistake. It's not 231% yield. I would love for that to be the case. You're looking at about 12% yield, just under 12% yield for QQCL and about 11.5 for USCL. So these are actually literally the indexes, right? USCL would be comparable to VFV and QQCL would be comparable to either ZNQ or QQC. QQC is the QQQ of Canada, right, by Invesco. And I have the data here. So if we do QQCL versus QQC, which is, again, the NASDAQ 100 index in Canada, you could actually see that QQCL, a covered call ETF in a relative bull market, 2024, is outperforming QQC. Pretty incredible. This is with dividends reinvested. And even with dividends not reinvested, which means you're just spending them, or you're paying your mortgage or a vacation fund or whatever it is, you're still outperforming. But again, look at these charts. They're so close, right? The perform, and it's always going to be this way no matter what, because it's the same index. Right. USCL, this is versus VFE, which I believe is the top stock held on Blossom, right? The S&P 500 without any Canadian currency hedging. And again, you could see beginning of the year till now, almost the last day of 2024, you see that USCL is outperforming VFV with dividends reinvested. Look how close it is. Not by a crazy amount, right? But it's still pretty good.
In fact, Adrian, to me, the fact that it's even in the same ballpark or even comparable,
exactly.
I think that, to me, like, the outperformance is almost a sweetener on top. The way I view it, right? It's wow. That, like you said, it's incredible. But even if
during a bull market,
that's what
which is not supposed to happen,
right?
Well,
I guess the way I view these funds is that they're spinning you off such and such income as part of a strategy. I don't come in with the expectation that I'm expecting to outperform. Like I said, it's a sweetener.
Same.
Even if it did underperform, again, it's the investment that suits my strategy as a passive income investor. That's what I'm happy with.
Exactly. Right. That is a fantastic attitude to have. I don't know if they're going to continue to outperform. I'm pretty sure if the market, the market's been on a tear, if it starts going a little bit more flat, sideways, a little bit down, I know for sure they most probably will, or at least have similar performance. Like, that's similar performance. So why is Why should someone, go from a VFV to a USCL, for example? What's the advantage there? Well, it's like you said, it's spitting out that very high yield, 11 to 12% yield, which you could do whatever you want with.
Some people
That's
need
the advantage. That's the flexibility.
That's what you're paying for, right? Exactly. That's what these funds aim to deliver. And for the right type of person, for the person following this strategy or this lifestyle or have X and X needs, that's when these funds come into place, right? And again, like you said, it's interesting. The total return, even being in a relative ballpark, maybe helps with the argument of even just for a bigger chunk of investors.
Even for growth investors, here's the key.
Yeah.
These income investments, these covered call funds, they could be great for a growth investor as well, as you just saw. If you don't need the income, that's the argument I get. I don't need the income. I'm working. I'm in my career. No problem. You get this, you put it on drip and you forget about it. It would be the equivalent of VFV. And here's the advantage later on. So later on, when you do need the income or you retire or you want to supplement your income, whatever it is, all you got to do is turn the drip off, my friend. Right. You don't have to sell anything. The person who invested in VFV or QQQ, you have no choice to sell at some point. So when do you sell? How much do you sell? What do you do with the money? What if you have to sell? What if the year you retire, the market goes down 15%? Kind of sucks. With the covered call stuff, you never have to sell. You just turn the drip off. You start using the income. And it's really up to you. You don't have to use all of it. You don't have to spend all of it either. You reinvest half of it. So there's much, much higher flexibility, I feel, with these strategies. This is a key advantage of owning the covered call version versus the regular index fund. Now, there's a stipulation, disclaimer. The 25% leverage one, these are the ones being the indexes. So if there's some that don't have the 25% leverage, they are underperforming a little bit. They're underperforming. So the leverage definitely does help, right? So just a disclaimer, because there's, I showed the leverage ones, but you have the non-leverage versions. They're pretty close, but they're not beating VFE.
So yeah, no, appreciate that. You kind of answered it, honestly. But maybe I do want to hear about some of the Harvest ones you have prepared, because Harvest, as my viewers know, is a huge sponsor of the channel, a huge supporter of us.
Same here, great partner. Great partner for me as well. And I saved them for last.
Oh, the best for last.
I'm excited about it. So I started with these on purpose because I think these are good basic ones to start with if you're starting to build a foundation.
Yeah.
Harvest has sorry to cut you off, my internet's not that great.
I had a question, but I'll save the question for later.
Okay. So you want me to talk about the Harvest news?
Let's do it.
Okay. So Harvest, let's allow
share screen again.
Yeah. So Harvest also has kind of their own, I would say, foundational all-in-one. It's HDIF, which is a combination of a lot of their covered. You can see my screen, right?
Yep, you're good.
Okay. So HDIF, it's very comparable with HDIV. There's some Canada, there's mostly US in here. That's another one to take a look at. But what's really exciting about Harvest is that they're dabbling in single stock covered call ETFs. They already have 4 that are out. They're called the high income shares by Harvest ETF. So they have Lilly, Amazon, Microsoft, Nvidia. So the general premise is really the same. Like I said earlier at the beginning, you could write covered calls on anything, right? So these ETFs, you scroll down, they actually have non-leverage versions, but those are quite boring if you ask me. If you scroll down, they got leverage versions, and these are extremely interesting. And by the way, it's still 25% leverage. It's still very, very decent, small amount of leverage, 1.25x basically. So here are the stock symbols on the left. So basically, these are ETFs that hold only one stock, right? Microsoft or Amazon, and they write covered calls on it, on the stock. So you're giving up some of the upside of Microsoft for that monthly distribution. So a lot of these have between 16, I think that the Amazon one has about 12, 13% yield. Microsoft's about 16. The Nvidia one's over 20% yield. Lilly's in about the 19, 20% yield. And they're only writing covered calls on 50% of the portfolio. So only 50% is covered. So, with a 25% leverage, you have 125% exposure to Microsoft. Cut that in half. That's what, 62.5. Only that portion is covered with covered calls. And then they're pretty much out of the money covered calls as well. So What I'm trying to say in layman's term, you're looking at about 60, my estimate here, 65 to 75% of the upside. You're capturing about 65 to 75% of the upside of Amazon, Microsoft, but you're also getting that really, really nice yield. Whether it's, and remember, covered calls is the premium you get is based on volatility. The more volatile a stock is, the more premium you get. Just like the more at risk you are, if you're a 20-year-old with a super sport motorcycle and you try to get insurance, your insurance premiums are going to be very, very high, right? Because there's more volatility. There's more chance of you going into an accident. It's the same thing with stocks. That's what dictates, by the way, the yield. It's the volatility of the stock. So what's exciting is that they have announced one for MicroStrategy, one for Coinbase, one for Palantir, one for Tesla, one for Meta. So they're going to have 1, 2, 3, 4, 5. They're going to have 9 total. And I think more are going to come.
Yeah.
But what's exciting is that, as you know, MicroStrategy, Coinbase, Palantir, Tesla, these are all very, very volatile stocks. So the yields are going to be astronomical. And my favorite part is that they're coming out with HHIS ETF. This is going to have all of them, basically, or a combination of most or all of them. So it's going to have the Meta one, the Tesla one, the Coinbase one, the MicroStrategy one, probably equal weight. So it's not an index fund, but instead of just getting the Tesla one, just getting the Microsoft one, you could get this one. It's going to have all of them. So it's kind of like a bit of diversification.
Yeah.
You're looking at 20 to 25% yield, my friend. So that's a really cool ETF that you could add if you want to add some yield, and even just adding a 5 or 10% position could increase the yield of your portfolio tremendously. So that's what Harvest is coming up. And, Purpose also has single stock covered call ETFs as well. But the Harvest ones, the Harvest is really known for consistent distributions. Plus, what I like about them, they're not currency hedged. So if the Canadian dollar keeps doing crappy like it's doing, it's not going to have it's going to actually have a positive impact on these ETFs.
Yeah.
So that's upcoming for Harvest, man. It's really exciting. They're doing a good job, obviously, with coming out with the things that, people want.
No, I've been familiarizing myself with these products, and Adrian, my investing style, which is why I bring you on. This isn't part of my investing style, but there are so many people out there that it is. And it's, I'm familiarizing myself with these products as we go, and I appreciate you explaining them in such a way to make it digestible, I guess, for my audience. Maybe one question I have on that.
Sure.
We talk about the different types of investors with different strategies. One of the questions we got from Andrew on Instagram, he said, are high yield covered calls, like let's just call them high income funds, such as these that we covered today, he's asking a question to you. Would they be recommended for all ages, specifically people in their 20s, 30s? I'm 30 years old and I want to create a vacation fund for myself. And I know we've kind of hinted at this the entire session about ways to use these and whatnot, but I want to just address that question right now, which I think ties into these different funds and who they're suitable for and whatnot.
100% yes. So for example, I have, young 20-year-old cousins that are in college. I told them best thing to invest in, that you could just not babysit the S&P 500, right? So he has HYLD on drip, which, as we saw from the chart, doing really well and even outperforming the S&P 500 a little bit. So it goes back to the flexibility. So like I said before, if you're a growth investor, if you're a young investor, if you don't need the income, everyone needs income, right? If not, why are you going to work? But anyway, that's a separate podcast. If you don't need the income right now, you could just turn the drip on, and you're turning it into a growth investment. Remember, when you think growth, I think growth is one of those terms that's very misunderstood in the investing world, just like risk. Growth is not the growth of the stock price. It's the growth of your investment. I think you would agree with me on that, right? You're trying to grow your money, your investment.
Of course, yeah, of course.
Right. So like we saw, and the proof is in the pudding, if you check out some of these funds, they have similar, identical, and sometimes even a little bit better growth or total return. When you think growth, think total return, and that'll solve all your problems. Right. So it could be good for all age groups. So younger investors, people who are, in their prime of their career, people who are about to retire, some people switch, and there's no right or wrong in investing. It's really what's right for you, I think. So whatever makes you feel comfortable. So to answer the question, the age group, it's irrelevant. It's good for any age group, because even if you don't need the income, if you're not a retiree, you put it on drip, and then you have the flexibility later, or the advantage later, of not needing to sell your shares. You just turn the drip off.
And
right?
especially if you're maybe in your 20s and you're using, your registered accounts like a TFSA, for instance. I was just thinking about taxes on the drips, right? Like that's
a good point.
Especially for someone younger who's maybe not using a bunch of non-registered money. It's very seamless. Just turn off he says here, oh, I want a vacation fund for myself. Maybe you've built up your TFSA, and then, whatever the case is, you turn off the drip when you need a little bit more income, cash flow coming in the door, right?
Or if you know how much you need for your vacation, these funds, especially in Canada, they're relatively very stable and consistent distributions, because you could really forecast how much you're going to get. So you might even, you don't have the drip turned on, and you let the cash sit there for a few months because you're going to use it in 6 months. So you have a lot of flexibility. And like you said, any registered account, taxes are not a thing, so it doesn't matter. In the non-registered account, if you're in your prime of your career and you're already in a high tax bracket in Canada, we know that taxes are high. Maybe these are not the most ideal. But one thing you got to remember as well is that covered call income in Canada is taxed really well. It's not dividend income, it's not interest income, it's capital gains and or ROC income. So, that capital, we all know that capital gains is taxed 50% better than regular income. But still, yes, you do get taxed. Whether you drip it or you leave it in, you take it out, doesn't matter. You always get taxed. So maybe for a non-registered, it probably would be better with a VFV that has a 1% yield that doesn't really hurt you as much tax-wise. But that's the spiel.
There you go. Well, here's a good one, Adrian. I mean, we talked about so many different investments today, and I mean, just being respectful of your time, I appreciate you sitting here and chatting with me.
I'm good to go as long as you want to go.
Then let's go. Someone else on Instagram, Walking the Way, they asked, what is his favorite ETF that he currently holds? And I feel like just high level, we talked about so many. I know you like them, a lot of them, but if you had to pick.
I get that all the time. I would say, some people think I'm crazy, but I actually consider myself a pretty conservative investor. If you look at my portfolio, maybe 80-85% is basically index-based covered call ETFs. My two favorite indexes, me personally here, the S&P 500 and NASDAQ 100, to cover the overall US market. I worked in the tech field. I'm a bit skewed. I really like technology companies. I think we'll need more technology in the future, not less. So I really like the NASDAQ 100 as well. But, there's a lot of overlap between the QQQ and the SPX. But I would say my favorite style of investing, and this is even as if I were to be a growth investor, it would be index-based ETFs. I just think no matter how much I think about it, and you think about it, it's kind of like the perfect way to invest. They're diversified, they're low cost. You don't have to worry, they're automatically rebalanced. There's just so many advantages. So I would say my favorite for my foundation would be definitely the index-based ones, which a lot of them I showcased earlier.
Yeah.
And those are, if you look at my portfolio, which I unveil every single month on my channel, those are my top positions. USCL, HYLD, QQCL.
And what would be your favorite if you had to pick, let's say, outside of that core foundation of your portfolio? Let's say you have more of your fun flyer ones. I'm sure there's
my fun flyer.
At the exact moment, what do you like?
It's got to be MicroStrategy, man. It's got to be MicroStrategy with covered calls. So again, like I said, covered call premiums are based on volatility. I don't know if you caught Michael Saylor's appearance on PBDs talking about, investing in MicroStrategy versus Bitcoin and whatever. MicroStrategy is the most volatile stock right now. So the yield you could get is basically 100% yield. So think about that for a second. You could get 100% yield in 1 year just off writing calls and selling calls. There's an ETF in the US, Yield Max. Yeah. It's MSTY is the stock symbol. And actually, the one that Harvest is coming out with, it's the same stock symbol, MSTY. So that's coming. And they're writing it on 100% of the portfolio. The yield is over 100. It's like 150% yield. Now that's fun. That's like a flyer, a really fun one. But what you're really investing in is really MicroStrategy, right? So that one's coming out soon from Harvest. I think the yield's going to be over 60% because they're doing covered calls on 50% of the portfolio, not 100. So my assumption is it's going to have like 60% yield. That's fun. That's a fun way to invest in Bitcoin, right? If you don't want to invest in the purpose yield one, you want something a little bit more crazy than just boring Bitcoin, right? Because Bitcoin is just going to get more boring over time. You can invest in MicroStrategy or in a MicroStrategy with covered calls. So pretty interesting stuff. That's definitely going to be fun to see the yield on those. Even the Coinbase one and the Tesla one, they all have very, very high yields.
Yeah, no doubt. Well, hey, why don't you take a moment and share a little bit about, I know you got some new cool stuff to share, like in this world, Adrian. I don't know if you have screens to share, but man, I want to hear it. I'm excited to hear what's new and fresh on your end.
Fresh on mine in terms of like new funds or just what my platform and what I'm doing?
Your platform, what you have going on. Let's see. Yeah, we've talked about it a lot. We've talked about your stuff lots in the past, and I've directed so many people to your digital products and whatnot over the years. I don't even know what's here new in the new year.
Yeah, so I actually came out with a new digital product. Just came out last month or a couple of weeks ago, called the Ultimate Covered Call ETF Guide, because there's just so many that keep coming out.
Yeah,
in Canada and in the US, it could be very confusing. Like your audience, if you just want to get started, okay, which ones do I go with? The Hamilton one, the Harvest one, the Global X, the Purpose, the BMO, the Brompton? There's so many of them now. Even JP Morgan now is in the game. JP Morgan's in Canada now, and the first two ETFs they launched in Canada are covered call ETFs, if you can imagine that. The same popular ones, the same stock symbols they had. Then there's the US market, right? Because as you know, Canadians, when you invest in US stocks, US listed stocks, very important. In the RSP, there's no withholding tax. So that could be very beneficial if, I don't know, you want to get some US currency, you have some US currency. One tip I have to tell your audience right off the bat, because it's very important, I wouldn't hold high yield US listed stocks, very important, US listed on the US exchange, in the TFSA or the non-registered, because there's a 15% withholding tax on all your dividends that you don't really get back. So if you have VFV, you have a 1% dividend,
that's it.
It's not the end of the world. But if all your returns are coming from a 15% yield, it is a big deal. So I would say if you...
Sorry to cut you off.
No, go ahead.
One of the most asked questions we get on the channel is exactly that. My dividends, my withholding tax, 15%. And my logic has always been, listen, if you're holding an S&P 500 fund, which doesn't even pay great dividends to begin with, like you said, you look at the top companies in the S&P right now, it's the Mag 7, which are tech stocks. They're not dividend focused companies. Yeah, you get a little bit of yield here and there, but 15% of that 1% dividend is so minor that it's not something to, again, you can obviously optimize and whatnot, and that's fine. But to me, when someone says, should I own VFB in this fund or this fund or this account?
Not worth thinking about.
Not worth thinking about.
No, it's not.
It's a very different story. I'm glad you bring that up when this is the priority you're investing for. So I'm very glad.
Very different. Very different. Because the yield is much, that 15% is a huge chunk.
True.
So go with Canadian listed. And it's okay because we have S&P 500 and USCL. That's Canadian listed. HYLD, that's Canadian listed. There's no problem. Yes, the fund inside pays those withholding taxes, but again, it's tiny because the US market, US stocks typically don't have very high dividend. Don't have a lot of dividend stocks, and if they do, they're very small.
Correct.
So anyway, getting back to the product, there's so many. So I'm like, you know what? Let me make an Excel file where you could sort by sector, by distribution frequency, by obviously put the stock symbol where you could click, it goes to the website. Do I have an interview that I interview the fund manager? I interview a lot of these covered call fund managers, almost all of them. Yeah. So I have a lot of videos associated with certain funds. So I put that in there. So I'll share and I'll show you, if people are interested.
I'm sure they are. Yeah. It's like a database, a big database, if you will, of everything you need.
You could say that. Yeah.
There it is.
So here it is. I mean, This is my website, passiveincomeinvesting.ca. If you click on digital products, you'll get two of them. This one we discussed, it's more like a full product, and it includes the ultimate covered call guide. And another thing is that my products, you only ever have to buy them once. They come with lifetime updates. So you buy it once and that's it. When the next version comes out, you log back into the website, you could download a new version. Why? Because there's always new ETFs coming out. So it's always has to be updated, right? So I try to do an annual update. But this one here, the ultimate covered call ETF guide, if you're just interested in covered call ETFs, that's all you're interested in, I created this product where you could sort the covered call, all the funds with a bunch of filters. Again, which ones are S&P 500, which ones are diversified, which ones focus on healthcare stocks, which one focus on technology stocks. And you could do an extract on ETF.com, but what they don't tell you is what is the option strategy of these covered call ETFs. How much is the fund manager covering? They're doing covered calls on 33% of the portfolio or 50% of the portfolio. What is the moneyness of the options, which pretty much dictates how much upside you're giving up. So I created this product that people could go through and really sort, and it's a good starting point, if you want to dip your toes and really not do hundreds of hours of research, because I already did the research already. And it's only $49 Canadian. Comes with lifetime updates. I got to raise the price is going to go up to $60.
Yeah, it's like a McDonald's. My McDonald's meals are $49 when I buy them for the family. That's
and you never have to buy it again, by the way. So it's very, very cheap. I'm not trying to make a lot of money here. This is these products, I kind of both created them for myself at the beginning to track everything.
Yeah.
So, and if you want something that's really full, it's the ultimate DIY package. It's this one here. It's $99 Canadian. It includes this product here. So you only have to buy this one. This one has a lot more stuff. It has a knowledge base. It has sample portfolios as well on the US side. On the Canadian side, it has blank portfolio template. It has all kinds of stuff, all you really need. So this is, basically my two digital products that I created.
There you go. Well, no, that's super exciting with the new one. And I've said this before when I've had you on, I will always be happy to throw people your way in that realm. Like you said, it's for $60, $100. I would say it's a no-brainer. It's a little no-brainer. And it's, again, it's an area of expertise that you have true expertise in. And, I'll just touch on that one point about, you talk about the option strategy. And, I work with many of these companies, and I get to speak with the fund managers and learn from them. And even for me, it's hard to wrap my head. Like if you just go to the website, let's say you're looking at BMO or Harvest, you really got to do your digging to see what's happening under the hood.
Exactly. You got to do digging. And even when you do the digging, you're not going to understand the terms that much. So this is why even in the covered call guide, my first tab is terminology. I'm explaining, okay, what does out of the money means, at the money, moneyness of the options, when do they expire? So the biggest feedback I've gotten from my people who buy my products is, I don't have 100 hours to watch all your videos, so I'm just going to buy it. That's the number one. And it's a great thing. Like the main purpose of these is to save you time.
Yeah.
And just to sift through, and you could sort through. And I'm always going to keep updating them at least once a year when new funds come out as well. So you only ever have to buy it once. And for me, this is what I live and breathe every day. One super cool advantage of being a niche YouTuber is that fund managers, they all contact me when something's news about to come out. So I'm up to date on everything, which is really, really cool. I get to interview a lot of these guys over and over. I've had the Hamilton guys, Global. I have them all on the channel many, many times. And they're very open and honest. And we talk about the nitty gritty of it, but sometimes it could be hard for people to understand. And that's why I gave those maybe 4 or 5 ETFs at the beginning. These are really the best to dip your toes in, because they're really boring funds. They're really comparable to the indexes, right? So
there you go. Well, no, like I said, you are always the guy that I direct people to. If you're not already watching, your channel, like I'll put some links below. I can put a link to your website there for people that are interested in the product. But Why don't we just finish off with one final question here? Just a
Shoot.
fun one. Here's a fun one. It's
Yes.
okay, this name's kind of silly. God bless the topless. I just read that now.
The topless?
God bless the topless
like
on Instagram. He asked if Adrian could start all over again, what would you do differently and why? And I'm going to assume he's
Great
talking
question.
about your investment strategy. Maybe, yeah, I assume that's what he's talking about. But let's finish off with that.
Yeah. So back when I started dabbling in stocks, 2011 or 2012, I wasn't an investor at all. I was a speculator. I was just trying to buy low to sell high, whatever was in the news. I was messing around with Air Canada stock and BlackBerry stock, Bombardier stock, a bunch of little oil companies. So what I would really have done, I think would have been amazing, is start as an investor, not as a speculator, because a lot of, I'm sure you heard this story a million times, man. When people start, I'm going to buy this stock, and they're skewed towards Canadian stocks. So they'll buy a couple of banks and other little stocks. And if you just start with indexes, you'll avoid so much heartache and pain. And it's never wrong to start with index funds, whether it's income or growth. I don't care. They're pretty much, as you saw with those charts, you're investing in the same thing. So if I could redo everything from the beginning, I would have just started as an investor. Of course, 2011, 2012, these funds didn't exist.
Right.
I mean, there was a couple. BMO had some, CI had some, but they didn't have index-based ones. There was maybe like, the Canadian banks with covered calls, but there wasn't an S&P 500 and NASDAQ 100. But I still would have preferred to just invest in the S&P 500 and NASDAQ index, and then maybe switch to income later once I discovered it, once, I wanted to get my financial freedom, etc. But I would say that's what I would have changed. I mean, there's a big difference between being an investor and a speculator. And it's a very, very key difference. And it's completely different.
Yeah.
Obviously, you watch the news and you're bombarded about the sectors and getting in and getting out and short term. That's all speculating. That's not investing. So I wish I knew the difference back then. But hey, it's been a journey, and everyone makes mistakes and learns. It took me like 10 years to get to this point, and I'm still learning. There's still new stuff coming out. It's an endless journey, right? As you know, investing. So it's really about finding what's best for you and sticking with it. It's thinking long term. Be an investor, not a speculator. Investing is boring. It's easy and it works. Speculation could lead to, it's like gambling. You could win jackpot once in a while, but the cards are stacked against you. The house is against you.
So true, man. No, that's age-old wisdom. I totally agree with that. Well, hey, man, on a personal level, I'm hoping you have a really awesome new year, and I appreciate you.
Yeah, you too.
Yeah, I appreciate you spending the time here and sharing all this insight with my audience. You guys leave a comment down below if you have any more questions for Adrian, or like I said, I'll link all this stuff below. But yeah,
I like doing questions, even live. I don't mind doing it. If you want to do another session, if you got a bunch of other more detailed questions, I could go through them with the proof, because I answer. It's pretty much always the same question, so I kind of know the answers by heart. But you could subscribe to my channel, Passive Income Investing. I'm planning to do a couple of more educational videos. Like I'm gonna probably do one. What are covered call ETFs in 10 minutes? That's one of the ones I want to do.
Yeah.
Because even myself, I've gotten a little bit better and better at explaining it. Because if you read it online, you'll get confused, right? Because you're not going to know what an option is and all this. But it's actually not very complicated at all. And I myself personally don't even have options enabled in my broker account. I've never sold a call option. I want to let the professionals do it. But again, you could do it yourself, just like you could pick your stocks yourself. You could write your own calls. You could buy Tesla and sell calls on it. But it's more complicated, obviously. But that's why I love these covered call ETFs, man. You let Harvest and Hamilton do it. That's all they do all days, write calls. So they're good at it. So
I'm a huge advocate of that as well. Very cool, man. Yeah. Well, hey, appreciate you being on, Adrian, and let's do this again soon. Maybe I'll compile some questions, and let's not wait a whole year next time. Maybe we'll see what type of questions come through, and we do a little follow-up just answering the viewers' questions maybe in the coming weeks or month.
Sounds good. And I one little thing to end. I saw that your portfolio is now basically ZEQT and VOO.
Pretty much. That's
your
exactly it.
portfolio. So you decided, let me just get rid of everything. And I'm kind of, heading in towards that direction. And like I said, 85%, eventually probably 95% is going to be combination of S&P 500, NASDAQ 100, high yield, with maybe a little micro strategy for my Bitcoin exposure and maybe that HHIS ETF from Harvest. But I have a suggestion for you, and maybe because I know a lot of people follow you and have ZEQT or XEQT or VEQT, all the EQTs, right? The whole world.
Yeah.
It's VTI. Sorry, it's VT in the States, and then you have the S&P 500. So I would check out Global X. They came out with 25% leveraged versions, growth versions of the S&P 500 and of their version, which is HEQT, right?
Yeah.
HEQT. So they have HEQL. Check out HEQL and USSL, which is S&P 500, 25% leverage, the whole world, 25% leverage. My assumption is you're going to be holding these two for forever, maybe?
That's the plan.
You think the markets are going to go up over time?
I think so.
Might as well get a little bit of leverage, hands-off leverage. You'll never get margin call. That's Global X's leverage, which interest rates are going down. And do USSL versus VOO. See which one's winning. You'll be pleasantly surprised. But anyway, just a suggestion for you, man.
Oh,
because
yeah, I'm almost sold, man. You keep an eye on my Blossom portfolio. You might see that one popping in there in the
yeah, it's like it's like two things, right? The whole chart is VOO, or I'm like, I hope he knows about the leverage growth ones now. They just came out.
I'm familiar with those products, but I'll sleep on that one. But no, appreciate the suggestion, man. I love that.
My pleasure. Nice talking to you, my friend. Let's do this again, and next time we could do questions or whatever you want to do.
Sounds like a plan, man. Appreciate you having you on, and yeah.
Happy New Year to you and your audience, man.
Hey, Happy New Year, Adrian.